Good evening. Welcome to the Private Property Podcast, where we provide you with valuable knowledge and information on all things property related. Whether you're a first-time home buyer, a seasoned investor, or just looking for some expert advice, we've got you covered. So tune into the show every Tuesday and Thursday at 7 p.m. for tips, insights, and expert advice on all of your burning property-related questions, because we cover all topics related to property. That's because this podcast is brought to you by Private Property. Remember, you can find your new home on privateproperty.co.za. Welcome to the Private Property Podcast. On tonight's episode, we'll be unpacking exactly what tax benefits property owners are entitled to. Joining me in studio is our resident tax expert, our fave, Natasha Lorde, who is the Managing Director of Lorde Business Solutions. But before we dive into the conversation, remember to comment below and share your thoughts about today's episode. You can do that and join the conversation by using the hashtag find your new home on privateproperty.co.za and hashtag the Private Property Podcast on all social media. We'll be keeping an eye out for your posts, and who knows, we might even feature some of your comments on next week's show, because we value your opinions and because this is the Private Property Podcast, where we provide you with valuable information on all things property related. Like I said before, joining me in studio, our resident tax expert, we have Natasha Lorde in the building. Welcome back to the show. How are you?
Thank you. I'm good. I'm glad we can stop saying compliments of the new year, but I am good. We've got tax season coming up, so it's very busy, but so far so good.
What do you mean we can stop saying compliments of the new year?
No, we're in March now.
It doesn't matter. If I haven't seen you since last year, I'm going to be complimenting you until December.
Oh my goodness. I need a petition to stop it from January. 1st of January.
No, that's not how it works. If I haven't seen you, it's compliments of the new year.
Do you keep your Christmas tree up? Because you seem like you can't.
This is none of your business, actually. And this is not what we're here to discuss. We're here to discuss tax, and I'm going to ask you tax questions, and you're going to answer them. Okay. First of all,
talk to me.
Property and tax,
Yes.
It's a thing.
Mm-hmm.
There are people who buy property specifically with the intention of writing off certain expenses on their personal income tax. Please tell me what the law says about that.
Okay. So we have the one that we discussed, which is Section 13(6), and that is essentially if you have 5 new and unused properties, you can use that to reduce your taxes. So again, it's not a cashback, but you can use it to reduce your taxes for 10 to 20 years.
Okay.
It's an amazing write-off. You can do that, and a lot of people also invest in Section J12, and Section 12J basically. Also, they really invest in properties. So it might be an indirect way of writing off your taxes or reducing your taxes, but that is a way that you can also hold some form of an investment that can mature over 5 years. So you can't take out your investment within a 5-year period, and you can write off the entire amount that you invest in your Section J12 in that year. So it's a bit of a Hail Mary. If you've got about a 2 million rand, instead of paying 2 million rand in tax, you might just want to put that in some form of an investment. So it's an incentive by the government to stimulate small economic growth, because venture capitalists or the venture capital industry is essentially there to go and stimulate economic growth and stimulate small businesses and just different enterprising, entrepreneurial ventures.
How many people know about this?
I actually don't know. I'm constantly speaking to people and clients about it, and you know, especially on the high net worth side, because they sit at the end of the tax year. And this is why I always say, prepare your game plan a year in advance if you can. Like, sit with a tax specialist like you would and have a game plan. And so when you get there, you know how much you're supposed to pay. You're not shocked, you know, you're not confused. You know your rand value, the ballpark figure of what you've got going on. We generally do a preliminary calculation. We're like, okay, this is what you want to do. These are the properties you want to buy it in. Is it in a trust? Is it in your personal capacity, in a company? And what are the tax events that come about with your life as you're living it this year, as you anticipate you're going to live it? And then you think, okay, you know, I'm contingent on this. If I do this, this is how it would affect my taxes. If I do that, that's how it will affect my taxes. And then we can rope in all of these different things, because some tax things that we do or tax strategies that we employ, you need to have it for a certain amount of time. But with Section 12J, people don't know that you can, again, it's like a Hail Mary. You've got should I take the 2 million and pay tax, or should I put that towards some sort of an investment for myself? You know, and that's, again, the government uses tax incentives or just disincentives as well to influence behavior. And one of the things is they want economic drivers, they want small businesses, and venture capital kind of performs that function on their behalf.
Got you. So I'm glad you brought up calculations. I want to know if one is taxed on rental income. So I've taken my money, I've invested in a property, I've got a tenant in, I'm getting rental income every month. Is that taxable? And if so, how are those calculations made?
It is taxable. So it forms part of your total income, and you might find that if you're not careful, it will put you in a different tax bracket. Yeah, and those tax brackets can have a huge implication, because now you're paying a lot of what you're doing with, you know, paying it towards tax. And so it's this kind of calculation that a lot of people don't include. So what they do is they say, oh, you know, I've got a rental property. This is the bond amount. This is maybe the maintenance amount. This is rates, taxes, and levies. And they think those are the only taxes. And then come tax season, they're like, oh no, I'm in a different income bracket, and actually I'm running at a loss. Is this actually an investment, or is it just an asset that I hold? And so when people are doing these calculations, when they're looking at investing, and this is why we also do property advisory, because we look at this and say, you need to account for other things other than just, this is the bond cost. These are the rates and taxes and the levies. That's amazing.
Like, you're not done. There's more.
Not done. There's so much more. So maybe look at, it's not that property is not an investment, it's just think of how is it working for you with your budget, with your area, with what you're looking at. And then you can say, have you incorporated all of these things? How long is it going to take you to break even? Because you might be cash flow positive, but at the end of the day, you're still going to take, 30 years to get to a point where you just break even. You've just paid off everything, and now it's a profit. So that's the difference. We have the language to distinguish between cash flow and profit, because if anything happens, it stops being, an asset in that term. It stops being an investment that gives you a return. It might
because you're losing money.
Because you're losing money, and you don't even know where the holes are. So you're just like holding something, and you don't know if that's something that is worthwhile the way you think it is. So we try and reframe it in a realistic way, because there are other elements to property purchasing aside from just, the bond cost and the rates and the levies and all of that.
It just seems like a bit of a trap, hey?
Yeah, it's because we don't have all of the variables. And if we're equipped and empowered with information, we can do better. And this is why, again, my practice has now evolved into more of property advisory. We even host events. We do all of these types of things to help people. Yeah, because we want to equip people with the right information when getting into a property purchasing journey. Because first of all, it's a big mistake to make. It's a very expensive mistake to make. Just the basics. Do I buy it in my personal capacity, in a trust, in a business? If you want to change that, you're going to incur fees for that. So if you want to start off the bat before you sign an OTP to actually have a scope. So what type of properties am I actually looking at, and how do I get to that scope? And that's where we come in terms of the figures, in terms of understanding. And then you go out into the world and find properties within that scope, within reason.
Can I reduce the taxable income on my rental income? Can I reduce the tax?
You absolutely can. Again, a lot of people don't make use of deductions. It is a lot more work, and I tell you why. Because there's a format.
You're taking me back to like just being in school and like what is that thing called? Accounting. And the income
debit credit.
Yes, a debit, and then it must be the same number at the end. It must balance in the balance sheet, and mine isn't balancing. So and now in my life, I'm not the one. I'm not good with numbers. I can present the heck out of a podcast.
You really can.
But don't
You really
ask me.
can.
Thank you so much. But don't ask me to do these calculations.
I
How do I
know.
now figure this out?
I mean, that's what we're here for, right?
Oh,
This is
okay,
what we
cool.
do. You just give us the stuff and we kind of do it and we explain to you. So the thing is, why people don't do this is because you need something called rental schedules. Now, we have it on our website for people who want to go and do that themselves, but you have to present it in a way, in a standard format that SARS can accept, right? If you are going to put it on your personal return. Why do you need to do this? Because you can't just fill in, oh, I've had utilities. I mean, now we've got load shedding, right? The cost of electricity has gone up. You can write that off. You can reduce your taxable income by that amount. You can reduce it by the amount of the interest on bond. We've just seen interest rates rise, you know? So you can reduce it by the interest rate of your bond. You can reduce it by if you've run a Facebook ad to try and get tenants in, you know, if you put it in the newspaper, so advertising costs. If you had to do transport to, you know, show people the
How do you
units.
prove all of that?
That's why you need schedules. And that's where we come in to say, okay, SARS is going to say, all well and good, fantastic, we'll accept that, but we need to see proof of that.
Yeah.
And so we give them a schedule to say this happened on this date. And if they want further proof, then they'll say, okay, please give us, you know, your bank statements or supporting documents, whatever that is. And then you provide them with that if they look into it. Most times with the capacity of SARS right now, they just stop at the schedules. So they have a specific format for that, you know. So it is something that you can do, but people don't do that. So say, for instance, you didn't have a tenant or you had to do some sort of repairs and maintenance, you can actually write that off. So
if my geyser bursts, then I can write it off.
you can write it off to an extent. So there's repairs and maintenance. I know. And then there are improvements where you've actually increased the value of the property.
Solar panels.
Yes. Now you can't write that off immediately. You can write that off when you sell the house, because now you pay capital gains tax, right? So when you sell the house, you can reduce it by whatever you've increased the value of the property by.
Of course.
Yeah. So it's big improvements. When we're talking repairs and maintenance, you know, we're talking light bulb here, you painted something there, but it didn't increase the value of the property. But that's the distinction we make. We'll look at it and we'll say, okay, yeah, this makes sense for us here. That's our job. We need to be able to distinguish between that. And then we'll sit down and explain that, you know, you spent 100,000 Rand putting in solar panels. That's really great. You could have gotten a deduction if this was in a business name, but it's not. And then you can reduce it. So there's something called Section 12B. And Section 12B is essentially there to help with solar panels and renewable energy. It's an incentive by the government. So if you do rental income or you have rental properties for the purpose of business, you can actually write off any kind of renewable energy. If it's biomass, if it's wind, if it's solar, if it's whatever it is, but it's renewable, you can write it off at an accelerated rate, which means 50% in the first year, 30% in the second, and 20% in the third year. Practically, 100,000 Rand is spent. This year, you can reduce your taxable income by 50,000. The next year by 20, and by 30,000, and the next year by 20,000. So it helps you reduce your taxes.
Hectic.
Section 12B.
I'm so glad we're doing this because I don't know how many people knew that. Listen, what happens when my expenses now exceed my rental income? I'm hemorrhaging money.
Yeah.
How do I fix this?
So in the tax sense, we would reflect that on your rental schedules, which is why it's also important. We're doing this for a client currently, and essentially you might be able to get a refund. Depending on what's happening with the rest of your taxes, you might be entitled to a refund for that portion.
What do you mean, depending on what's happening with the rest of my taxes?
So if you don't,
I don't have enough money in the account.
Yeah. So if like there's nothing else that is going to cause your taxable income to increase, then it could result in a refund. That's what can happen.
Just tell us how to get the refund.
I know, we're here for that. But you have to have that asterisk. You have to say T's and C's apply. T's and C's.
Not the fine print.
The fine print.
Listen, what expenses are not deductible now that homeowners consistently try and include in their tax returns?
Wow, there are quite a bit.
Give me like three.
I would say, entertainment costs. Yeah, I would stick to kind of let me give you just a whole framework. Anything that does not help result in a tenant being in your space is not a deductible expense.
Okay.
So for instance, every expense that is allowable and deductible is one that has basically aided in you carrying out the sale or putting in the tenant in your property. So it's hard to even say not entertainment costs, because you could make a case that no, I had to,
have canapes.
Yes, because it was for a viewing, and we had a whole bunch of people come and view the house
every Sunday for 3 months.
And so there's the entertainment cost, But if you just bought it and now you want to throw it in, but you have a tenant in, then it stops being for the purpose of putting a tenant in there. So you need to be able, and that's why we sit down with people. It's personalized. It's not, I can't just say, but the framework is, what did you do to get a tenant in here for you to get income? And whatever you did, those costs, the costs that you incurred for the sale is what you can include and write off.
Petrol.
It's transport. Did you have to go and show? Yes. Okay. We can reduce it by that much.
Electricity,
definitely.
Because you need to turn the lights on so they could see if it was warm light or cool light.
Yes, for the property you can. All the utility bills, your water, your electricity.
Because you have to test the water pressure before you move into a place.
Any professional fees, all of those types of things, you can write it off. It has to be in the schedule. We have to make sure that it makes sense, but you can write it off. What did you do to essentially, it's a business, right? So what happened with this business? What was the cost for you for the sale? What was the cost of the sale? And we sit down with that. And so what we try, and this is why we talk about knowing things a year prior, because maybe you went to Leroy Merlin for this potential thing, or you went to Builders, or was it for your primary household? We need to be able to see that. So when we sit down with people and they know that they're going to be doing something, or they know that this is impacting their taxes, they're very mindful of that, and then they set it aside for us, and then we can know, okay, this is what happened. Because especially when it's personal and it's in your your personal bank statement, you would definitely forget. So it helps to know, okay, this impacts my taxes, so let me make a note of it, or let me keep it aside, let me put it in a Dropbox, let me prepare for my tax season.
What are the most common mistakes that people make now when they're trying to get these write-offs?
They don't have proof. They don't keep the proof, or they don't remember.
You have no receipts, ma'am.
You have no receipts. And they just don't remember. Because again, it's like, I remember, doing something, but I don't know what it is. And then another thing is cash. So if you're paying your gardener, your helper, or something like that, or you're running an Airbnb and you're doing that periodically, my suggestion is have a cash book, have them sign.
A paper trail is vital.
Yes, have a paper trail. And it's not uncommon to pay people in cash, but it's extremely hard to prove. We can try and make a case for it. SARS might accept it, they might not accept it.
Like here's when I went to withdraw on that day.
And so we can try, but it's so much better to have something prepared where we know, okay, this is fortified. We know what we're doing. We know we have a case for it. Actually audit us. It's fine. Here's the proof. We have a trail. So that's my biggest mistake. And again, this is why we say, and we emphasize on it, if you know you have rental property, you're going to have rental property, educate yourself, or let us help you in terms of what do you need to do to prepare? What do you need to do to set yourself up in the best way?
What's another mistake?
Not submitting. People just leave it out of there. Right.
I was going to ask about that because, there's it's optional, right? They ask, do you have any rental income? And it's easy to not disclose that.
Exactly.
But obviously it's not the right thing to do.
Actually, one of my clients did that. And this is the sad part about it. So he didn't disclose it. And SARS was like, look, we have your IRP 5s. We know how much you earn. So what is this extra income?
Yeah, where did it come from, honey?
What's going on, right? And he left it for a while. You get these, you're like, I'm not going to look at this. And
Notice.
You're just like, I SARS, archive, don't want to look at that.
Yeah.
Actually block. And you're just like, he came to me kind of a year later. Now SARS gives you quite a good period of time to respond within. But it was a really long time, so he didn't disclose it. And then they said, but you've earned this. It's bumped you up to a new tax bracket. Actually, you need to pay us 60,000 Rand.
You owe us money, bruh.
You owe us money. And then when we did the rental schedules, we're like, no, but you were running at a loss. You're actually entitled to a 30,000 Rand refund. So had you actually come to us or just done it, it wouldn't have been this. And then it was a big schlep because now SARS was like, nope, we're not accepting this. Especially they don't want to give you the money back.
Yeah, obviously, but you've also been dishonest, so it's almost like they're like, you need to feel the consequences
and they would deduct, because they also have the right to garnish your account. So there was this fear pending of, oh no, they're just going to come and take it, but technically you ran at a loss, so it's not that great. So we had to do so much to just get SARS's ear to say, okay, no, we are contending this, we're disputing what you're saying, please take a look at this, please take a look at the schedules to get this resolved. And they're like, okay, no, we understand, this is what's going on. Contrary to what most people think, like SARS is very, very open to communicate, very open to resolving what's going on, because they want compliance. You know, that's their primary kind of core thing that they're aiming towards now. You know, the commissioner has really emphasized on that in terms of the compliance of South Africans right now is not that great. So the biggest thing is submit it, because you never know, it could actually work out in your favor, but for sure if you don't, it will not work out in your favor.
And eventually the system will catch up to you. Like
exactly.
The house always wins.
The house always wins.
Please give me a checklist of which documents a homeowner needs to keep on file for their tax returns.
Okay, so big ones, any expenditure, again, that was carried out to have that property. So repairs and maintenance, you know, gardening, cleaning costs, all of those things, keep that on hand. You need to have your rental schedule, you need to have any kind of invoices from your management company, things like that, but mainly it's just supporting documents. More than that, there really isn't that much to keep on hand. Yeah, nothing much.
So if everyone's fine.
Everyone's fine. You just don't keep like every receipt of every expenditure that you incur just for living. It's really specific for that property or those properties that you have rental, you know, purposes for. So that's what you want to keep.
Before I let you go, we're expecting the State of the Nation address today, actually. Obviously, it will be followed by the Finance Minister doing his. So if you really apply your mind and based on your experience and your outlook and what you see, do you think that homeowners are going to get any kind of tax reprieve in 2023?
Specifically to homeowners, I don't see much of that happening currently. I really don't. If anything, I know that there's going to be a big emphasis on the impacts of what is happening with the economy in terms of staying. So we're probably going to look more in terms of immigration and what are those impacts in terms of tax, because, you know, we saw about 6,000 people leaving South Africa, immigrating out, and, you know, the commissioner is now saying, well, we don't know if they really were in the higher tax paying bracket, if that's going to impact our taxes. Yeah. And that's the important thing, because we've got 90% of our state income coming from taxes. So we need to figure out, you know, what are we doing to improve that? We might see something in terms of wealth tax, so that might impact, you know, your estate. They're looking at about a 5% wealth tax on anybody who has, I think, over 30 million in their estate. So that might be impacted.
That is not me or anyone in my family. So we're good.
We're good. So we might see that, which I don't see how that might, you know, they want to use that to basically do some sort of UBI, so basic income for people, take 5% of the wealthiest people and give that to people. But we might not see that pass over well because we are, again, trying to retain people. We've seen a bit of, you know, infrastructure investment from the US. So I'm not really sure how that might impact homeowners, but it might, you know, they're trying to keep the case for South Africa is still a place you can invest in. South Africa is still a place you can buy property in. So we are looking at maybe having that as setting a standard on a global stage, that South Africa is still investable, because the US is doubling down on its infrastructure investments in South Africa. So we could see a few developments happening in terms of trying to convince South Africa and the rest of the world that this is still a place to be in, and this is still a place for you to be, you know, an economically viable place. That might trickle down into how we think about ownership and how we think about particularly home ownership. I would love to see a lot more in the incentive of, you know, home ownership. But we do have a few things. We have FLIS for first-time home buyers. So we also speak to people about that for the lower earning people, between 3,501 Rand to 22,000 Rand. And then again, we've seen Section 13 Sex, which is there to stimulate people in terms of developers, in terms of building low-cost housing foremostly, but also just housing in general, even if it's new houses. So we are seeing a few things.
Got you. Yeah. Thank you. I'm going to let you go. Awesome. But when they make their nice little speeches, then you must come back and then we're going to discuss
We'll
that.
debrief.
We're going to unpack it. We're really
it.
just going to
Yeah.
take a look at how this affects South African
Yes,
homeowners
yes.
and how they can pay less tax.
Always there for that.
Natasha, thank you so much for joining me today.
Thank
It's
you for having
always
me.
a pleasure to speak to you. And that is all I've got for you tonight. I will catch you on the next episode of the Private Property Podcast. I'm Sibs Matiela. Good night.